Today I'm making room for APLY since it launches tomorrow, the covered call ETF by Yieldmax funds, APLY, APLY. It actually doesn't do covered calls, it does synthetic calls most likely. It doesn't own the underlying, but it's like covered call funds. So we're going to sell one of our other covered call funds, JEPI, to make room for that. So we sold 10,000 JEPI already. So 10,000 here, as you see below, JEPI. We sold that for a decent profit. Okay, we just don't want to sell for losses when we make way for new holdings in the portfolio. Whenever I sell things in margin, I want to make sure it's always done at least a break even. So we did that, and we took a couple $100 gain in JEPI, but we still have 15,000 JEPI on here. So we're overloaded in JEPI, overweight, and it's a covered call fund once again. So I think it makes perfect sense to sell some JEPI here, make some room for APLY. And JEPI covers the indexes, it falls like the S&P. So since Apple is such a large part of the indexes, it makes sense to have some APLY in the portfolio. And I'll probably keep about 3 to 4K in APLY because I don't like stock exposure over 1,000. As you can see, most of our stocks down here below, we have about $1,000 in. So when we talk about TSLY or APLY, we'll have $4,000 or so in them because they're large parts of the indexes. And you're not just obviously taking standard, just outright stock risk. You're going to get paid back with the dividends. So I don't mind having a little bit more in those, again, because they are index based. So we're going to get good correlation with the indexes if we have these two in our portfolio as a larger weighting, and the dividends will pay back any losses incurred. So really like the idea of an APLY. Obviously, I love Apple. I would have Apple in my portfolio right now if it paid a dividend, but APLY pays that dividend. So I also want to make a little bit more room and sell my last financial USB for the slight gain that I have there, because it doesn't pay me enough of a dividend compared to APLY. And yes, I know I'm bullish on banks, so what I ended up doing was just selling a put on banks. So FAS $55 put, made $1,500 in it. So we're up like $100 in it, but we're not going to go for the 100. We're going to go for the full 1,400, and that lowered our margin significantly. So we took our margin from about 260 to 245 here because we had about 10K in financials. We had 3 to 4K in APLY at one point. We had 4 to 5K in other banks. Now I've sold those, and I also sold the put on FAS to make more room for APLY. So I'm going to go ahead and sell UBS now, USB, I'm sorry, here. The market's already closed, but I'm going to put an after hours order in. So sell 59 is the bid, 35.59, looks pretty liquid between 59 and 60. So these help you get out in the after hours. So I'm going to sell here. We're going to go do a limit order. Limit, good for extended hours, 7 to 8. I just want to do the limit price of $35.59, $35.59. Here you go, preview. Still $35.59. Okay, $35.59. Sell place. Okay. I believe in USB. I think it's going higher. I love the banks right here. They're at historical prices. Look at our last videos on the banks. USB, Bank of America, all those guys. I really do love it, but I can't. I have to make trade-offs when I'm using margin. See, my margin level here is 244,000, and I can't just have that run up forever and ever because I'm getting charged 5% interest. So that did give us a gain, a little bit more of a gain for the day. As you can see, gains and losses on the 17th here, a little bit more now because of USB. Again, I'm not in it for these gains. I just don't want to sell for losses when I'm shifting around in the portfolio. When I'm, changing my allocations or I'm upgrading or downgrading names, you definitely don't want to do so at a loss when you're running margin like I am. That 250,000 margin, when you take losses, it eats into your account significantly. So I can't afford to do that. So our income and value, well, before we go to our income, let's just show you my performance. It's 15%. The brokerage is up 15%. NASDAQ is up 15 as well. We're in line with the indexes. Dow Jones is up 2. The S&P is up 7. We're currently making about $106,000 per year in dividends. Okay, so APLY is going to contribute to that significantly tomorrow. Let's go look at a chart of APLY and see where that falls. Apple. Let's see how the stock is trading, and that will indicate how aggressive we can be in APLY itself. So we're at a chart of Apple, and as you can see, it's at its highs, or it's not far off its highs. See, the old highs here in August was 170. Now we're almost back at 170. So it would seem like there's resistance here on Apple. However, if you look at it on a chart, on its 5-year chart, you'll see that it's on the 200-day moving average. See, we tagged 125, which is a 200-day moving average. Very important line there. And on the 10-year chart, we tagged the 50-day, excuse me, the 50-day moving average, that purple line. See this purple line, the 50. So that's very significant. Whenever Apple tagged that 50 in the past, 50, tag the 50, we bounced, okay? Every time the RSI hit 50, 50 right here, and 50 right here, it corresponded with the bottom in the stock. So RSI at 50, bottom of the stock, RSI at 50, bottom in the stock, RSI at 50, again, could be a bottom in the stock here. And we made this nice basing pattern for a while. We consolidated all of 22 around this pattern, around 150, around this price. So to me, Apple looks neutral. Does it give a buy signal? I can't really tell. It looks like it's at 1-year resistance almost, but it also looks like it's consolidating for a move up on its 5-year and 10-year charts. When you look at a 10-year chart of the S&P, it looks the same. The S&P tagged the 50-day moving average. Apple didn't even really get down to there because Apple was showing a lot of strength. And that makes you wonder, is Apple and FANG and the rest of those large cap tech companies like Microsoft, are they going to have a consolidation year or a down year while the rest of the market moves higher? After all, Apple and Microsoft and those names held up well during 2022. Maybe this is another year of digestion for it or lower stock prices. It can happen. But it's really hard to bet against that. And again, ultimately, it looks like it's following the S&P. And why? Because it is a large part of the S&P. So, Apple, been really excited about APLY. Okay, I've always wanted more exposure to Apple. It's a cornerstone of most fund managers' portfolios. So it's really important to have it. It just didn't pay that dividend. Now, when you look at that chart, if you remember that chart that I just showed you, it looked like it's at resistance, near-term resistance, or it could be setting up for a long-term multi-year move higher. But at any rate, even if it moves sideways to down from here, well, that's a perfect time to sell covered calls on APLY. So using APLY to sell covered calls would be a perfect strategy. Tesla, we said the same thing. Tesla had almost 100% move up from the lows from 100 to 200. And while it's digesting its moves, that's when you sell covered calls. And so TSLY is the perfect fund for that. Now, you're not going to get the monster gains if Apple goes up and if Tesla goes up. You're not going to participate in that kind of fashion. That's why I like to tie all my other investments to the indexes, which Apple is a large part of. However, if you want to increase your dividends and you want to do it in a way that gets you the most bang for your buck, these Yieldmax funds will accomplish that for you. Now, even if the stock or the fund APLY launches tomorrow and it drops for the next couple of months, I'm going to continue to buy it. I'm going to buy it right away. I don't like FOMO or fear of missing out, but I'm going to buy in position so that I don't get hurt. I'm going to buy 1,000, and keep it about 4,000 to 5,000 of my portfolio because, again, I told you I don't like to have too much stock exposure. I will have a little bit more, though, because it's a covered call fund and the dividend will pay back losses. So I don't mind having a little bit more in that, but let me tell you that if you're nervous about APLY in any shape or form and you don't want to buy the launch tomorrow, you could always buy APD, which is the short of Apple. So I was thinking about buying about 3,000 of APLY tomorrow. I was going to buy in positions 1,000. Yes, but if I buy the short, I can buy a little bit more of APLY and not feel like I'm too exposed. So APD is the short for Apple. So even if you own Apple right now, it might make sense to have a little bit of a short if we're near the highs. It's hard to bet against Apple, though. It's everyone's favorite stock. But nonetheless, this is a vehicle you can use. If you're feeling a little bit skittish about Apple or APLY, you can go to APD. I'm probably going to buy about 2,000 of APLY tomorrow, 2 to 3,000, because I want that income. I love seeing my income increase. But I'll buy probably $500 of that APLY, of that APD short, just to let me sleep at night and know that if we have some dramatic fall in the market or Apple, then APD is going to take care of that downside for me a little bit. Plus the dividends of APLY will pay back all losses, like I keep saying. So I'm not really worried about any losses in APLY. As long as Apple's doing good, APLY should be doing well. Except if Apple, for some reason, like TSLY, loses its volatility and starts chopping lower and grinding lower slowly, then that's going to be terrible for the covered calls, and that's going to make them have to cut dividends. It's going to reduce the NAV. There's going to be NAV erosion, and again, more dividend cuts. However, when you're playing with a stock like TSLY or APLY, a fund like that, and they have 20% dividends or more, all you have to do is hold the stock or fund for 5 years and you're paid back. So even if they cut the dividend multiple times and it ends up being about 10% of a dividend, it doesn't matter. Then in 10 years, you're paid back. So you can't say the same for Apple. If you're in the stock for 10 years and it's going sideways or down, you're not paid back at all, but you would be in the covered call fund. That's why I like APLY and the idea of these Yieldmax funds, which I'm so thankful for my subscribers because they were the ones who gave me this idea. So you saw my performance and value. We're up for the year. You saw my estimated income. APLY is going to contribute to that significantly tomorrow. I don't know what the yield's going to be. I'm sure it'll be somewhere extremely elevated. I don't know. OARC was 40, TSLY is 60 something. So I'm sure APLY will be close to that. So if I buy, let's say 4,000, you're going to see this income jump by at least another 1,000 per year, which is another, almost $100 per month. So we have to pay the bills and live our life and live financially free, and doing so with dividends. And I think APLY and TSLY are just more sophisticated ways to accomplish that goal of being financially free. I don't think they're overly risky. I don't think you should have too much money in them, of course. And if you do, like with OARC, I have 10K in OARC, as you can see here. But I do have SARC as my hedge against that, the ARC hedge, SARC. So keep that in mind. If you need a hedge, you have SARC there. You could put more or less in that. So there are ways around these funds if they fall. But again, if you just sit there long enough and hold till your investment is cash flowed from the dividend, then you have nothing to worry about. I would say the only thing left to worry about is just performance with the market. And I got to tell you, if APLY is doing bad, if Apple and Tesla are doing bad, the rest of the market is probably not doing too well. And so you're not really worried if they're falling, because a rising tide raises and lowers all ships. And if it just so happens to be that Apple and Tesla are outliers and the rest of the market goes higher, well, we're ready. We're positioned for a move higher in the market. We're highly levered to the upside. And again, if TSLY and APLY, stagger around here and chop around and even lose some value for us, well, the dividends will pay them back. So anyway, made that room, sold JEPI, sold some of my banks, all my bank stocks, sold the put instead, raised all that cash, made room. So we're ready, locked and loaded, ready for APLY tomorrow. Can't wait. Please leave comments in the comment section below if you have any other strategies that you want to share with APLY, or if you have any more information on it. Other than that, stay tuned for tomorrow's video, because I'll cover the launch, I'll cover the buy, and then hopefully all of y'all can weigh in and we can assess what happened on the first day of trading in the APLY fund. So I hope you enjoyed the video. Click like or subscribe if you already have. I appreciate it. If not, please do that, and I'll talk to you soon. Thank you.